If you're like most taxpayers, whether you're a W 2 wage earner or a business owner, or maybe you're something in between, there's a very high chance you're missing out on deductions. And no, it's not because you're careless, and no, it's not because you did something wrong, but it's because the tax codes are complicated, and no one ever breaks them down in plain English. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out the blog site where we post every Monday, Wednesday, and Friday. As a CPA and tax advisor, I review tax returns every single year, where people have been overpaying, sometimes for years, simply because they don't know what to look for. So today, I'm going to walk you through the most commonly missed tax deductions and credits, and how to make sure you're not leaving money on the table. So let's get into it. Most people don't realize this, but if you take the itemized deduction on a Schedule A, you can deduct either your state income taxes that you paid or your state sales taxes that you may have paid throughout the year. You can't deduct both, but what we will do is take whichever one is higher, whether that's the state income taxes that you paid, that's going to be on your W 2, or if you kept track of all the state sales taxes that you may have paid throughout the year. So, if you bought a car, renovated your home, made a large purchase, or live in a state without income taxes, sales tax might actually give you the bigger deduction. This is especially overlooked in states like Florida, Texas, Nevada, where there is no state income tax. If you made a big purchase, this one matters. When people think about the charitable contribution deduction, they usually think about writing a check to their church or their favorite nonprofit organizations. But you can also deduct clothing donations, household goods, mileage driven for volunteer work, and out of pocket expenses while volunteering. That bag of clothes you dropped off, that counts. The mileage you driving to volunteer, that counts. But you need documentation. Receipts matter. Photos help. A donation log helps even more. Small amounts throughout the year can add up to significant deductions. Let me clear up some confusion with the home office deduction, especially since the pandemic, now that more people are working from home either full time or part time. If you're a W 2 wage employee working from home, you generally cannot deduct your home office anymore under the current tax laws. But if you're self employed, that's different. If you use a space in your home regularly and exclusively for business, you may deduct a portion of your rent or mortgage interest, your utility bills, internet, home or renter's insurance, and even depreciation. A lot of business owners avoid this deduction because they're afraid of audits. But here's the truth: if it qualifies and it calculated correctly, it's legitimate. Here's something most people don't realize about that retirement contribution they made throughout the year. You can still make contributions to certain retirement accounts up until the tax filing deadline, not December 31st. That includes traditional IRAs, SEP IRAs, and solo 401ks. I've seen clients reduce taxable income by thousands just by making a strategic contribution before filing. And you're not just reducing taxes, you're building wealth. That's smart tax planning. If you have a high deductible health plan, you may qualify for the Health Savings Account or HSA contribution. HSAs are powerful because they are tax deductible going in, they grow tax free, and they withdraw tax free for medical expenses. That is what we call a triple tax advantage. Yet, so many eligible taxpayers don't max them out. Education benefits are usually missed or misunderstood. These are credits like the American Opportunity Credit, the Lifetime Learning Credit, and deductions like student loan interest. If you, your spouse, or your dependents are in school, even part time, you may qualify. Credits are especially powerful because they reduce your tax bill dollar for dollar. If you pay for childcare so you can work or look for work, you may qualify for the Child and Dependent Care Credit. This credit includes if you paid for throughout the year daycare, after school care, summer day camps. It does not include overnight camps. Many parents assume that this isn't deductible, but it can directly reduce your tax liability. Energy efficiency credits for the upgrade of your home and or vehicle are also widely overlooked. But recently, tax laws have changed, so maybe you may have to do a little bit of homework on this one. So, if you've installed energy efficient windows, some sort of energy efficient installation, heat pumps, and solar panels, you may qualify for the energy tax credit. These are credits, not deductions, which makes them even more valuable. And the rules have expanded in recent years. So, like I said earlier, it may be worth reviewing if you made upgrades, but also be sure to check with your tax professional on what may or may not be included in the tax laws that have recently changed. This one is surprisingly common. This one is commonly overlooked, and people usually forget to include their estimated payments made during the year, and also those state tax payments made in January for the year prior. If these aren't properly reported, you could appear to owe more than what you actually do. Always reconcile what you paid. In my experience, deductions get tax credits and deductions get missed for three main reasons. The reasons why most deductions or tax credits get missed are because of one, poor documentation. This is going to be the number one downfall for most people is they don't document, and if it doesn't document, it didn't happen. Not understanding the eligibility. Sometimes the tax codes can be a little bit hard to understand. There's a lot of different things and different eligibilities that make you either eligible or not eligible, depending on the phase out, if there's any income limits and all that. So it's good to work with a CPA or a tax professional. And not proactive tax planning. This is a big one. Tax planning should start not in January, but in June to make sure that you're on the right path and to see where you are going to be at. So be sure again to work with a tax professional. Tax preparation is historical, it looks backwards. Tax planning is strategic, it looks forward. And most major savings happen before December 31st. The tax codes isn't about loopholes, it's about incentives. The government incentivizes tax or retirement savings, business ownership, education, energy efficiency, and charitable giving. But if you don't know the rules, you don't benefit. If you found this video helpful, hit the like button and be sure to subscribe for more tax tips videos and share it with someone who might be overpaying in taxes. And remember, taxes is all about timing. I'll see you in the next video where we'll break down itemized deductions. Are they worth it?